What happens to your debt when the dollar collapses? The notion of the U.S. dollar crash may seem far-fetched, yet economists and financial professionals have spoken about it in great detail. What would happen to personal debt in the event of a dollar collapse, which may cause hyperinflation, skyrocketing interest rates, and extensive financial disruption? What effects would this have on Kreditkarten, Hypotheken, und andere Kredite? This thorough analysis will assist you in comprehending the ramifications of a dollar collapse and the actions you may take to safeguard your finances. Number 6. Beschreibe den Dollar Crash. The term dollar collapse describes a sharp and quick decline in the value of the U.S. dollar in the international financial system. It happens when investors and foreign governments sell off assets denominated in dollars as confidence in the currency declines. Important elements that can cause such a collapse are as follows: excessive national debt. As of 2025, die US owed over $33 trillion in national debt, raising doubts about its viability. Growing debt levels own a clear repayment strategy may damage investor trust in the currency. Uncontrolled inflation. Concerns about hyperinflation arise when hohe Inflationsraten die Kaufkraft des Dollars verringern. A decline in trust in the currency may result if inflation gets out of control. Geopolitical risks. The dollar's reputation throughout the globe may be weakened by events like trade disputes, wars, or economic sanctions, especially if nations begin to stop utilizing the dollar as their reserve currency. It is crucial for people to comprehend how a dollar collapse may impact their personal finances, since it is often followed by hyperinflation, rapidly rising interest rates, and economic instability. Number 5. Der Effekt eines Dollarkollapses auf individuelle Schulden. A dollar collapse will affect various personal debts differently, depending on the type of debt, interest rate arrangements, and general economic circumstances. Here's a deeper look at how it affects various debt kinds. Fixed-rate debt. In the fall of a currency, can fixed-rate debt, like a conventional mortgage, or a fixed-term personal loan easier to handle burden? This is the reason inflation lowers the value of real debt. The actual inflation-adjusted value of your debt falls as inflation rises. For example, if you have a $200,000 mortgage and prices and salaries increase dramatically due to inflation, the amount you owe will be less than your income. Stable monthly payments. Even if inflation soars, your monthly payment will stay the same since the interest rate on fixed-rate debt is locked in. In times of turbulence, this might provide a feeling of financial steadiness. Debt with variable rates. In a currency collapse, debt with variable interest rates like credit card balances, adjustable-rate mortgages, and certain school loans poses a serious danger. Increased interest costs. In order to fight inflation and currency depreciation, lenders may increase interest rates. This might lead to a significant increase in the cost of paying variable-rate debt, was making it more difficult to manage. Unpredictable payments. Budgeting may be challenging due to the uncertainty around future interest rate increases, which may put a strain on finances. Foreign currency debt. Repayment expenses might skyrocket in the event of a dollar collapse if you or your company have debt denominated in other currencies. Weakened dollar. When the value of the dollar declines, you will need more dollars to pay off your debt by converting it into other currencies. A lower dollar, for instance, can make your debt repayments much more costly in terms of dollars if you owe money in euros. New debt. After a currency drop, lenders are likely to tighten credit requirements and raise interest rates on new loans. This can increase the cost and restrict access to borrowing for Häuser, Fahrzeuge oder andere Verwendungen. Number 4. A dollar collapses, wider economic consequences. A sinking dollar affects the whole economy, not just individual debt. Here's how. Inflation. Inflation results from the rising cost of imported goods and services as the currency depreciates. The cost of necessities like food, petrol, and gadgets may rise sharply, placing a burden on family budgets and lowering buying power. Interest rates are rising. The Federal Reserve may increase interest rates in order to fight inflation and stabilize the currency. Higher rates raise the cost of borrowing for both consumers and companies, auch wenn sie foreign investment anziehen und die Currency boost. Unstable economy. A currency collapse could trigger a severe recession or even depression. Companies may find it difficult to survive, which might result in layoffs and increased unemployment rates. People would find it much more difficult to pay off their debts as a result of this vicious cycle. Reduction in worldwide impact. One of the dollar's main advantages is that it is the world's reserve currency. The drive for alternatives to the dollar, such as cryptocurrencies or currencies backed by gold by nations like China, Russia, and others, may reduce demand for the dollar globally and hasten its demise. Number 3. How to get ready for a collapse of the dollar. Some proactive steps can protect your wealth, even though no one can predict the future. Spread your assets widely. Precious metal. Historically, gold and silver have served as safe havens in difficult economic times. When the dollar declines, their value usually increases. Real estate is a solid long-term investment since its values usually stay up with inflation. Cryptocurrencies. Although they are risky, cryptocurrencies like Bitcoin and others are becoming more and more well-liked as decentralized substitutes for fiat money. Lessen your exposure to debt. Pay off variable rate and hoch interest obligations as soon as you can. This reduces your exposure to rising interest rates. Refrain from taking auf additional debt, es sei denn, es ist absolut erforderlich. Create an emergency fund. Maintain a liquid, readily accessible account with at least 3 to 6 months' worth of living costs saved. This may act as a safety net in times of economic turmoil. Number 2. Purchase securities protected from inflation. Treasury inflation-protected securities. TIPS are U.S. government bonds that safeguard your buying power by adjusting in line with inflation. Examine international investments. You may lessen your dependency on the U.S. dollar and diversify your portfolio by investing in foreign companies or currencies. Number 1. Things not to do. Speculative investments. Steer clear of risky ventures that could depreciate in a tumultuous market. Over-reliance on cash. When inflation occurs, cash holdings rapidly depreciate. Invest in a variety of assets that will increase or hold their worth. Ignoring the warn signs. Keep up with Marktentwicklungen and modify your financial plan as necessary. In conclusion, although the prospect of a U.S. dollar collapse is depressing, being aware of its ramifications might help you be ready for the worst. While variable rate and foreign-denominated loans could become more difficult to handle, fixed-rate obligations might become simpler. Building financial resilience, diversifying your asset, the greatest strategy to protect your financial well-being in the face of uncertainty is to be proactive and knowledgeable. Remember that preparedness is the key to surviving any storm. Don't forget to like, share, and subscribe for more amazing content.